Many of you have been asking, I don't get it. What is a warehouse line of credit? All right, super easy, let me explain. Unless you are a bank and you are a lender, you need to borrow money as well, right? If you're a bank, you don't need to borrow money. If you're a bank, you technically borrow money from your depositors. People with their checking and savings accounts, they come, they deposit their checking and savings with you, you give them a super cheap rate of return, at which point you raise a bunch of funds, you go out and lend said funds. But most lenders, especially in today's environment, are independent mortgage bankers. That means they're not owned by a bank, they're not a bank, so they have to go raise their own capital. Well, that capital is called a warehouse line of credit. Typically, most large independent mortgage bankers have 3 warehouse lines of credit. So essentially, that independent mortgage banker goes to 3 different banking institutions and they open up a line of credit. They use that line of credit to fund the loan you originate, to fund your borrower's loan. And then when they sell that loan off into the secondary market, whether it's to Fannie or Freddie or whether it's to an aggregator would be someone like PennyMac or someone like NewRez, then they get the money for the loan, they're able to pay off their warehouse line of credit, and then they keep the spread, the difference, or what's called the profit. Something that everyone should understand about warehouse lines of credit is that they come and they go. They have very restrictive covenants that if you are an independent mortgage banker or you work for an independent mortgage banker and you're not meeting their standards, they could cut you off. Well, it's like anything in life. If you got cut off of your one and only air supply, or you got cut off of 2 of your 3 funding sources, that could be detrimental for your business. Your warehouse lender also does things like they tell you which loans you're allowed to fund using their line of credit. So if you see a bank or a lender pulling back on certain products, it may not have been their decision. It may have been the decision of their warehouse lender. So in a nutshell, warehouse lending or warehouse lenders is where independent mortgage banks, I'm talking from number 1 in the country all the way down to number 500 in the country. It's where they go to raise the capital that they need to fund the loan in order to then sell that loan in the secondary market. Couple tidbits of information that I like to know about warehouse lending is that understand the warehouse lender never funds the full 100% of the loan amount. So if a lender is lending like, let's say 300 grand, then the warehouse lender may only give them $285,000. That's called a haircut. Meaning, if you own or operate or run an independent mortgage bank, it's great that your warehouse lender is giving you the money to fund your closings, but keep in mind, you have to be able to cover that haircut that your warehouse lender is going to impose. And then lastly, it is a line of credit, therefore it comes with interest. And there's something called interest rate risk. I won't get into that today, but you all should at least be aware of what is a warehouse line, what does a warehouse lender do, how do independent mortgage banks use their warehouse line, and what's the functionality. So now you know.